Hello, this is Brian Resney, President of Resney Wealth Management. I'm bringing you an important update today about the economy and the investment markets so you can better understand what we see and what we're doing in order to manage your portfolio properly. Now, obviously, we have a number of clients, and clients have different risk profiles, whether that's growth or whether that's income, and different risk profiles based upon volatility of a portfolio. As the quarter ends, each and every quarter, we basically look at our relative strength indicators based upon our market sectors. And some of those sectors will come out of the portfolio based upon weak relative strength. And also we're looking at our market trend indicators, which help us reduce risk in our equity-based part of our portfolio in severe down markets. Officially, last week, the ECRI, which is the Economic Cycle Research Institute, came out, and they've been a great predictor of past recessions. In fact, they correctly predicted 6 of the last 7 recessions. They came out last week, towards the end of the week, and basically predicted that they feel that we are strongly going into a recession, that all their leading indicators are definitely leaning towards that. Because of that, we raised some further cash last week. Because of that, today, because the quarter has ended, obviously on Friday, we typically will do a reallocation rebalance either the last day of the quarter or the beginning of the next quarter. And today is our day that we actually are doing some rebalancing. We're actually raising additional cash. What that basically means is this: we're selling riskier assets more in the stock market, ETFs, equity-based investments, or mutual funds, and we are holding on to more cash than we normally would. We'll continue to raise cash if we deem necessary. Obviously, in an equity-based account or growth account, we'll have more cash because we're selling more equity-based investments. Equity investments typically do much poorer in a recession. In fact, the average equity investment will typically drop the stock market related 40+%. We've already seen a pretty steep drop-off between 10 and 12% last quarter, and that is one of the reasons why we've already started to raise cash in our accounts or selling risk assets. Some of our accounts do own quite a bit of individual bonds or bond funds or bond ETFs. We'll continue to hold those if those are appropriate. I believe high-quality bonds that are diversified are appropriate even in a recession. Granted, you may see a little bit of volatility from those, certainly not to the degree of volatility you would see from the equity market. So, if we are raising cash, cash typically goes into a money market. It doesn't mean we're going to wholesale everything. We're not going to be emotional investors, but we're going to do what's prudent and proper for your portfolio. Remember, if you've got an income portfolio, we're keeping at least 5 years predictable income on the front end, and that would typically be in the income-related area like bonds or assets that basically generate an income stream for your portfolio. The assets that are more on the back end for more growth or equity based, we've greatly reduced our positions in that. In fact, today, because it is a day that we are doing a major change in the portfolio, we're actually raising more cash and selling more equity based risk assets in the portfolio. Unfortunately, the indicators that we're getting, not only that we've seen over the last month or so, month and a half, plus ECRI, plus a lot of the other information that we're getting, is greatly pointing to more downside risk. And bottom line is this: I'd rather give up a little upside potential than take another big hit in our client portfolio. So meaning we're taking risk off the table, we're selling riskier assets like equity-based investments, and we're raising our cash stake. Now, when our market trend indicators dictate and our relative strength rebalance indicates on a monthly and or also a quarterly basis, we'll start adding back to our normal progression of investments. But right now, we feel being more cautious, raising more cash is the prudent thing to do. If you have any questions about your portfolio, if you're concerned about your money, instead of being an emotional investor, give me a call. Let's talk about your feelings. If you have any questions, we are here to help you. Remember, our #1 priority not only is to make you money, but also help protect from some of the downside exposure if we do go into a severe recession. We're doing exactly what we're supposed to do, but if you have questions, feel free to call us at any time. Hopefully you can listen to this Sunday show, and if you do have any questions, call the office, and make sure you have yourself a great day.